mentioned a word called as tracking error. Can you just elaborate what is a tracking error and how customers or investors can make use of this to compare different funds within the same category based on a tracking error?
Sure. See, any investor who is evaluating performance of active funds is evaluating by fund's ability to generate alpha. Because objective of any active fund is to generate return which is better than the benchmark. While objective of passive fund is very different. Objective of passive fund is to generate return which is very close to the benchmark return. So funds which are having low tracking error helps you generate returns are which are very similar to the benchmark return, which is the end goal of investing in these passive funds, right? So while selecting any fund within the category, you should be choosing a fund which is having lowest tracking error in the category.
Okay, that means this is the ability of the fund manager to ensure lowest gap between the fund return versus a benchmark return. Is that
Absolutely,
so?
absolutely. Funds which are having low tracking error end up generating return which are very close to the benchmark.
Great. Thank you for answering that. Now, moving ahead, we wanted to understand when you're managing closely around 20 plus funds within the index and passives. So, what are the key learnings and how do you manage this such a large scale of the different styled passive funds all alone?
Sure. See, style it plays a very important role while managing active fund, but ability to manage funds in a efficient manner plays a big role while managing passive funds, right? So we at UTI are very focused on this business. Currently, we are managing AUM worth of 1,20,000 crores spread across these funds, across ETF and index fund, right? And we believe that passive funds have a long way to go because whenever markets are initial stage of development, alpha generation ability of the active managers is much higher. But once markets evolve, and which means that alpha generation starts diminishing for active managers. So there is a role for both active and passive. We believe that active and passive complement each other. So in any investor's portfolio, both has its own advantage disadvantage. So distributors and investors should build a portfolio keeping this in mind.
Great. So, when you say that advanced markets, these are the mature markets which have a more adoption or tilt towards the index fund. Is that so?
Yes, developed markets such as US, size of passive is bigger than active. And in
Oh,
fact, on incremental flows perspective, also large amount of flows is coming to passive funds. Right? We are seeing similar trend building up in India as well. So, for example, size of passive funds was just about 1% of mutual fund industry's AUM 10 years back, but now it has grown to 17% of mutual fund industry's AUM. So, we are seeing phenomenal growth in passive funds, mainly driven by these simple to understand smart beta fund, simple to understand funds across uh, plain vanilla market cap oriented fund, thematic sector, and smart beta fund. So within passive funds also you get wide bouquet of product. It's not that passive funds are boring in nature.